I'm Hilary Dudley, Managing Director of Citadel Fiduciary. Many of our clients are asking us what are our expectations from this year's budget speech, particularly in the context of personal income tax and estate planning type taxes. This year's speech is sure to be an especially highly charged event, set against the backdrop of SONA, calls for a tax revolt, rumours around Brian Molefe being earmarked for appointment as the new Minister of Finance, and civil unrest, with the cry of fees must fall still ringing in our ears. The Davis Tax Committee's second and final report on estate duty, released in August last year, points towards the introduction of so-called wealth taxes, albeit indirectly rather than by introducing a new specific wealth tax. We are watching with great anticipation to see whether some of the various recommendations made by the committee, including abolishing spousal exemptions and rollovers for donations tax and estate duty, whilst increasing the estate duty exemption, are implemented. It is possible that the estate duty rate may increase, although estate duties presently count for only a small portion of revenue collected and are not generally viewed as the solution for collecting more revenue. The introduction in March 2017 of Section 7 capital C to the Income Tax Act will generate donations tax on interest-free loans to trusts and will go some way towards addressing this issue. Another suggestion which has been bandied about is that the CGT inclusion rate may be leveled across all taxpayers, be they legal entities or individuals. As there is a 40% disparity between the individual and the trust inclusion rate, it is difficult to imagine what might be the new inclusion rate. There's also a view, although it was disregarded by the Davis Tax Committee, that levying both estate duty and capital gains tax on death is effectively double taxation, so it will possibly be controversial if both of these taxes increase. It is anticipated by many commentators that the maximum personal marginal rate, which is currently 41%, may increase to as much as 45% for individuals earning more than 1.5 million rand per year, thus highlighting Treasury's focus on higher income earners. The VAT rate has been fixed at 14% since 1993, and VAT payers constitute the broadest tax base. There is a view that the best way to raise a large chunk of additional revenue required is to increase the VAT rate by 1 or even 2% while introducing a wider range of exempt goods so as not to negatively impact on the poor. However, this is viewed as unlikely given that it is an election year and also given that this will only serve to increase financial inequality in the face of slowing economic growth.